Welcome to RenMac Off Script. We open to discuss markets, economics, policy, history, and life. It's the 13th of September, 2024. I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Pavlik.
As a reminder, all the charts that we reference are posted to our Twitter account at RenMac LLC and our RenMac LinkedIn page, and you can subscribe to us on YouTube as well. I won't give you that address. I think you can probably figure that out. Lot going on this week. We certainly had a debate that seems to have come down more favorably in terms of the incumbent. But let's talk a little bit about the Fed first. Neil, we had a Fed meeting, we had CPI. Where do you stand right now between 25 and 50 for next week, and why?
Well, it's no secret that I think they will go 50. We've been arguing that, and we've been doing this long enough to know that it's kind of pointless to just change the call at the last hour just because the markets aren't priced for it. I think that's kind of useless if you're in this business, as you know. But what I would say is, the rationale to do it is pretty straightforward, I think. It's number one is the balance of risks are changing. There's more upside risk to unemployment than there is upside risk to inflation. And the Fed is still very far away from neutral. If you look at their own central tendency, the high end of the central tendency for the longer run federal funds rate is 4%. So that's kind of like a ceiling on where they think neutral is. The current rate is still well above that by at least 150 basis points, higher than the ceiling on where they think neutral is. So going 50 isn't really going to change that. And I also think Powell is different, right? I mean, if you look at the totality of the Fed speak over the last month, the most dovish speech came from Jerome Powell. He overemphasized the labor markets. He talked about how they don't seek or welcome a further weakening in the labor market. And guess what? Ever since then, the employment data has been weaker. The rate of jobs growth has been slower. Unemployment has been somewhat higher. Job openings are lower. If you look at regional factory surveys, it all shows contraction in employment. It's welcome that layoffs are low and jobless claims remain low, but at the same time, if you're waiting for those things to turn, you're kind of talking yourself out of kind of sticking the soft landing here. So, in other words, things like jobless claims are not the leading indicator that people have historically made them out to be. They're, if anything, coincident, but they're more episodic than anything. I mean, they tend to spike. So if you're waiting for that to happen, you're waiting too long. So I think there are a lot of good reasons to go 50. I think there are also good reasons to not go 25, right? I mean, so if you go 25, to me, that basically means that the dots will show 75 basis points worth of rate cuts between now and year end. So given where the markets are priced, it's almost impossible to deliver the so-called dovish 25 basis point cut. I don't think that's really a feasible option. I think the markets probably would not like that too much. And if financial conditions tighten as the Fed is trying to ease them, it could be a big problem, right? The whole point is to lower borrowing costs to kind of stabilize the economy, given the shifting balance of risks. If they go 25 and signal less than what the markets anticipate, which I think it would be likely because it shows that they're trying to build too much of a consensus, frankly, then you could see a scenario where interest rates go up as the Fed's cutting. I mean, how would that be a welcome thing for them? So I think those optics are worth avoiding. And, I mentioned Powell. Look, I mean, one of the benefits of Jerome Powell, in my opinion, is that he doesn't have a PhD in economics. That means that he's not encumbered by a lot of useless information. He's sort of more of a markets practitioner. And, I remember when Trump was president, he made the point about feel the market, right? I mean, look, I think that's worth keeping in mind. I do think that, this has nothing to do with Trump, obviously, but I think that Powell is a lot more less predictable than some of his immediate predecessors, namely Chair Yellen and Bernanke. And, he can do the rug pull. And, and the last thing I'd say is, like, do they really want to do this again? Like, remember in July, it was, well, we didn't cut, but we thought about it. We thought about going 25. And that came out in the press conference and, in the minutes thereafter. Do they really want to do that again? Like we cut 25. Well, we thought about 50, but we decided against it, only to go out and do it again later. I mean, like that's a recipe for just falling further behind the curve. And if you go back to the initial tightening cycle, does anyone honestly believe that if given the opportunity again, if they could go back in time, would they honestly start with a 25 basis point rate hike? They probably would have started sooner and gone a little bit more aggressively up front. So, I think if you don't learn the lessons of the past, you're doomed to repeat the same mistake. So I think it sort of makes sense in my mind for them to go 50. I've always said that's what they should do. I think that's also what they will do, just because to me it's a very, very compelling case. I mean, you're gambling if you only go 25 with the economy, particularly given where the balance of risks are at the moment.
You think it's fair to say that they are unburdened by what has been?
I don't even know what that means.
Well, you saw it in the data from Ally this week, right? You saw it from JP Morgan. All of these, banks have, not all, but a fair number of banks have commented on the deterioration of loan books. And that's exactly what should start happening, right? So certainly the sequencing of all this is pretty typical of what we see historically. The question is how quick can they get in front of it, and how soft or hard do they end up pushing the economy lower? Um, and within that, I mean, I think a couple interesting things that we've seen from a market's perspective. The market had an intraday reversal on Wednesday, kind of a strange place in a chart to have that intraday reversal, but certainly did. It followed through yesterday, today being Friday. It followed through yesterday on Thursday with a 3-to-1 breadth move. Starting to see a little bit of an impact on some of these more cyclical areas and beta areas of the market. And it's happening, I think, interestingly enough, as utilities, food, beverage, tobacco, some of these very defensive areas of the market are seeing excesses in our frenzy work, buyer frenzy work. In other words, there's a fair amount of positioning for the upside, further gains in these names. And usually when we see that in things like ETF flows and things like option skew, it's the point that we look for these things to pause and take a break. So I suspect that defensive trade is probably a little bit vulnerable here in the interim. I don't think it's a big top, but I certainly think that it's something that you want to prefer to be a buyer of weakness versus chasing strength. I'll come back to a couple other areas, but let's talk a little bit about the debate, Steve. Pretty clear that Kamala outperformed or outshined her counterpart there. What's been the impact on polls? How important are these historically? And kind of what's the strategy moving forward? Does she want to take on another debate? Does he want to take on another debate to redeem himself? What's the chess match there?
Well, sure. I mean, objectively, Harris had the better performance. You saw a 10-point swing in the Real Clear Politics betting markets average, and you saw actions speak louder than words. Trump going into the spin room. Obviously, Harris didn't need to do that. And we always say in politics, if you're explaining, you're losing. And clearly, Trump was the one doing most of the explaining. I think the jury is still out as to, whether or not winning debates necessarily correlates perfectly with winning elections. And I think there's some recent examples to point to that it doesn't. Polls suggested at the time, and betting markets did too, that Hillary Clinton won all 3 debates against Donald Trump. Obviously, she didn't go on to win. You had polls and betting markets again, at least for the first debate between Mitt Romney and Barack Obama, suggesting Romney won. Obviously, he went on to lose. So I think that's sort of, again, the jury's out. You had a lot of online polls suggesting that Harris, won the debate. I don't think there's any much debate there. I think we're still going to have to wait another week or two to see what effect, if any, this had on the small number of persuadable voters. A CNN poll taken after the debate showed that 4% of respondents thought it help influence their decision. Now, you might say that's a small amount. Again, that's probably expected because most people are locked into their views, but we're talking about an election that's going to be decided at the margins, therefore margins matter. But one thing I think that Harris, I don't know, did, if you sort of look at a New York Times Siena College poll, particularly amongst the battleground states, heading into the debate right before it happened, suggested that many voters felt that they didn't know Harris's policy positions, or the ones that they thought they did know, they thought she was too liberal. And so while sort of publicly pantsing Trump may rile up the base, and that's good from a fundraising perspective, getting the base energized, I think she didn't really, I don't think, in my opinion, provide any more clarity as to where she stands on positions, why her positions may have changed. That was sort of the missed opportunity for Trump. The last 5 minutes, he sort of remembered, oh yeah, this is what I was probably told to do. And that's what he sort of tried to link her to the Biden policies and sort of question, why have your policy positions changed from where they were 4 years ago? But I think at that point it was too little too late.
He
Yeah.
is who he is, right? I mean, this notion that you can actually teach an old dog new tricks, right? Like that I think, isn't that part of the problem with Trump, right? I mean, like no amount of debate prep is going to keep him. I mean, and first of all, let's be clear, like, yes, Trump has a lot of practice with debates because he's basically been in or running for office for the last, gosh, I mean, what, since 2016. I mean,
Yeah.
so,
Decade, basically.
yeah, almost a decade. He's not a particularly good debater. I mean, he technically lost. I mean, if you look at the polling, he lost 3 debates to Hillary, lost several debates, a couple of debates to Biden. He didn't even bother debating any of his Republican adversaries in the primary election. And Kamala Harris, sorry, excuse me, is a former prosecutor, right? I mean, she knows how to prosecute a case against somebody, which I think she did quite effectively. But this whole notion that you can actually get Trump to stay on message. I mean, it's like stuff that you learn about like when you're doing Model UN and like how to like bait people and debate them and like here's a big trap. Let's talk about your crowd sizes and your rallies. And he just, no, let me just walk right into that quicksand. Like he can't help himself. Like that's just the issue. He
Yeah.
is who he is.
Yeah.
I mean, that's also, I think, a benefit to him because everybody knows. So your opinion of the man is locked in already.
Right, and that's sort of my point, is by keeping the focus on Trump, where at this point after a decade, opinions are well known. That's where I'm waiting to see whether or not the needle is really going to move in those swing states. In terms of what may have changed, I've heard people argue that Trump's campaign is better, that the candidate may not be necessarily as good as he was at 16. I think that's pretty subjective. One thing I would blame the campaign for, not necessarily in the debate prep or lack thereof, but more in the decision to debate Biden early on. Had they waited till after the Democratic convention to debate Biden, then Trump would be up against Biden and probably would have, at least relatively speaking, had a better performance, or Biden would have had that performance that we saw in June, and that would have probably improved his electoral prospects. Again, hindsight is what it is, but if there's a critique of the campaign, that would be one that I would probably level at it.
Let's move into the Fed announcement for banks and capital ratios, Steve. Just give us a real quick update. What happened there? Really a nothing burger, if you will, for the banks, at least the way that they responded. But it's probably a bigger deal than what was characterized.
Well, sure. I mean, I won't bore everybody with Basel III, something we've mentioned before, this global push to raise capital standards following the great financial crisis. It's to just sort of remind people how long this takes, sort of fighting the last war. But the Fed sort of put out an initial proposal to raise them, I believe, by 19%. And there was a big industry effort to reduce those. And I think the Fed eventually sort of retreated, and this week to propose a much lower 9% level. There's still some question whether or not that banks may even try to go further and say, we don't even want that. So we did sort of release this new comment period. One of the reasons that elections have economic consequences and can impact your investment decisions is, we'll see if Trump comes into office, whether his administration wants to even proceed with this. I think that's still an outstanding question. But to your point, it was sort of overshadowed, I think, by the deteriorating credit quality concerns, as well as some of maybe the downtick in sales and trading and investment banking revenue. Just a reminder that, while things may seem like a big deal in DC, that I think was a good illustration of, the context matters. And at least that's what markets sort of, how they reacted the way they did that day.
Has there been any shift in the Senate race in terms of, I think it was pretty high probability the Republicans were going to win the Senate. 51, I believe, was the floor. Has that changed at all since the debate?
Not in the polls. Again, I think we're going to take another week or two because most pollsters are going to go out these next few days after the poll. It's going to take them a while to compile it and release the data. So I think we'll see if there's any real-time effect. But actually, the Cook political report moved Montana from toss-up to lean Republican. That was something that the University of Virginia under Larry Sabato did, I believe, the week prior. And West Virginia is already sort of firmly in Republican territory in both prognosticators forecast right now. So that would give Republicans a floor of 51 Senate seats, which means they would have a majority. So when you think about many of the things that Harris is proposing, particularly on the tax side, that's not likely to come to fruition in a divided government scenario. In fact, I think that's probably the most disinflationary scenario of sort of all the potential outcomes. So I think that's really important, something that investors should keep in mind when you're hearing a lot of these policies. Again, they would require legislation, and gridlock is good because it provides some certainty as to most of this just isn't going to come to fruition.
Right. Well, in terms of the overall market, how we've seen things this last week, I think probably one of the more notable is the oversold condition that's developing in energy. They're not good trends. The sentiment has certainly started to percolate in the right direction, meaning the excess outflows in ETFs and some of the option work now suggesting people are playing pretty seriously for the downside. Usually when we get that combination, there's some type of low building. I think it's probably just tactical here, but they also do have very good valuation support in our contextualized valuation work. So I think that's interesting. The other thing, a little bit of a curveball is what we're seeing out of gold. Gold made a new high. Silver looks to be hot on the trail and about to do the same. So the precious metals certainly much better looking than the industrial metals, but notable from our work. Neil, what's on the docket next week other than the Fed meeting?
Well, other than the Fed, we're going to get some data on retail sales. That'll be due up for August. Remember that, this is a nominal data point. So the fact that gasoline prices have eased over the months should weigh on the headline. But on top of that, we did have very weak auto sales. So I think that's important. And also, I do think there's probably some hangover potential from Prime Day, which was in July, I believe. So to the extent that July was juiced up because of Prime Day shopping, maybe you see some give back in online retailing. So I would, be expecting, a soft report. Income growth, generally speaking, has been slowing as well. And I think, my sense is that most of the gas savings is probably saved, not spent. So I'm thinking that the number comes in a bit weaker for retail sales. We'll also get industrial production. Remember that manufacturing employment has been contracting of late, so it's hard to see a big pickup in factory production in August. And we know that factory production has been, kind of sluggish in recent months anyway. And then we'll get some data on housing, so starts and permits. There is some anecdotal evidence that builders are doing a little bit better in August, so maybe that means you get a little bit more single-family construction. So we'll see, and that's pretty much it. Some regional manufacturing data points for September. We'll round it out.
Right. Well, we're going to be watching key levels in the market. 5670 is the previous high on the S&P, so that's resistance. 5167 continues to be support. That's a fairly large range, about 10% range, but certainly that's two very, very important levels on the S&P as we go forward. Still in an uptrend, which I think is important just as the default indications. On the 10-year yield, 403 resistance, support at 325. That's on the 10-year yield. Continue to see those yields trend lower with really definitive downtrends in place in the bond market. Join us again next week. We'll be 1 week older, 1 week wiser. Don't forget to follow us on Twitter. And if you want deeper insight, you can join us at RenMac Access. That's renmacaccess.com. Until then, I'm Jeff DeGraff.
I'm Neil Dutta.
And I'm Steve Paddock.
We'll see you.